Good morning, everybody, and thanks for joining this short session about emerging markets and ESG. ESG is becoming a very important topic across the globe, and what we want to do and share with you over the next couple of minutes is the question, or the answer to the question, does ESG work everywhere in the same way, or are there regional and local differences that you should consider if you look at your investments? But before we do that, I would like to give you a short introduction who we are. We are from Vontobel Asset Management, and everything we do is labeled under three easy letters. It's MTX, which stands for metrics, and you will see later on what that kind of metrics really means for us. We are emerging market equity experts. All we do is managing emerging markets in three different strategies. One is a global EM strategy, one is an Asian carve-out, and one is a Chinese carve-out. As you see in the top chart in the middle, end of September, we managed roughly 10 billion euros in those kind of three strategies. The team that is responsible for doing that consists of 21 investment professionals. As you can see here, there are two portfolio managers. The most important guy, of course, on the top is Roger Merz. He founded MTX and brought the investment philosophy and approach to Vontobel. Together with Thomas Schaffner on the left-hand side on the top, he is responsible for managing the global EM strategy as co-managers. We really believe in that kind of structure where four eyes see more than two. They are supported by a couple of people on the implementation side and then two client PMs, and I'm one of them. My name is Marco Lenfers, and I'm very excited that you all joined to listen to us today. Then we have a couple of fundamental research analysts. They are focused on sectors that they cover onshore Chinese or on a global scale. You see that indicated by the different color dots. We have two quantitative analysts, and then we come now to the essential part of what we discussed today. We have three own ESG people on the team, and you will see later on why we believe strongly that you need that own expertise and you cannot rely on what rating agencies are doing. The team is split across two different regions. The majority is sitting in Zurich, and the remainder of the team, for the time being, three people, are located in Hong Kong directly, and they bring in, of course, the local culture, the local language speaking skills that you need for onshore China investments. So let's look at ESG, and starting with the question, is it a good idea to use the same ESG approach across different regions? We feel clearly not. And to underline that with hard numbers, we have done an ESG study over the last couple of months, and I want to share a few results with them. So what we did is we compared global equities, which is basically what you know as MSCI World or MSCI All Country World, and then we looked in particular at emerging market equities. And we grouped the companies in those different areas in four different quartiles, depending on their ESG rating that comes in that respect from MSCI research. So we used an external source because we wanted, of course, to have a broad coverage in those kind of markets. Once we mapped them in those quartiles, we looked at the performance of those companies. And you see the performance on that chart. In black, this is global equities. In blue, it's emerging market equities. And you see ESG works. The good companies, they have a good performance also in terms of financial market performance. But there's a huge difference that is directly obviously if you look at the chart. It seems that in global equities in developed countries, ESG is a much better indicator for performance than it is in emerging market equities. So look, for instance, the difference between the top quartile ESG companies in developed markets compared with the worst ESG companies, it's 7.6% performance compared to 3.7%. Then you do the same math for the emerging markets, the blue one. It's only a difference of 80 bips between the first and the worst quarter. So there seems to be a very different way that ESG can help you to achieve alpha, can help you to achieve performance if you compare those kind of developed and emerging markets. So then, of course, you have to ask yourself a very interesting other question. Might there be a better indicator for performance in emerging markets? And we also tried to explore that. We also now took into account profitability of a company. Again, we split by emerging equities and global equities. And what we now did, we grouped the universe in the good companies in terms of ESG in the 4 quarters that you see. This is now blue, same numbers like on the last page. And then we added ROIC. This is return on invested capital. So that indicates how profitable a company is. And again, we took 1, 2, 3, and 4 in terms of quartiles, depending on the profitability. We grouped those kind of companies, and then we did the math and looked at the performance. And look what is now indicated by the black bars in terms of ROIC. It seems that the most profitable companies across the globe have the best performance. That's true for emerging equities, but it's also true for global equities. But then if you compare again the first quarter to the worst quarter, the difference is much bigger for emerging markets. So 3.6% compared to 1.3% for the worst quarter, which means an outperformance of 230 bips for the most profitable companies, much more than the outperformance of ESG. If you go to global equities, then the difference between the best quartile and the worst quartile in terms of profitability is not that huge. So ROIC or profitability might be much better indicator for performance in emerging markets than for global equities. But then, of course, as ESG is also important, we have to think about how to integrate ESG. Because for having a holistic picture on a company, we still feel ESG is worth considering. So let's just focus on the top profitable companies, the first quartile in terms of ROIC, and then let's have a look on how ESG works in those kind of subsegment of companies. So we're just talking about the most profitable ones, and those we have again divided in 4 groups depending on their ESG ratings. You see the black one that are the top ESG, the blue one, the second quartile, the third quartile is yellow. And you see the first 3 quartiles, they are pretty close together. Obviously, there's a huge difference then to the 4th quartile or the worst companies in terms of ESG. So we feel that if you take all that charts and numbers into consideration, you should consider ESG. But you should focus on avoiding the most risky ones. So the pink ones, they should drop out of your universe, and that will help you to increase your alpha over time quite significantly. And the second consideration that we feel is a very important one, ROIC is one of the indicators you should really focus on when it comes to company evaluations. So this is part of the big study that we did. If you want to learn more about ESG and find out a couple of other different things that was the result of our study, then please join my colleagues, Lara, which is our lead analyst for ESG, Roger, the team head for MTX, and my colleague on the client PM side, Mark, for that webinar. You can click on that link and see a discussion about the ESG study. And as you can see indicated on the left-hand side, there are a couple of more interesting findings exploring ESG in emerging markets from different angles. So now we have taken very important conclusions. ROIC is important in emerging markets. It's important to avoid the most risky companies in terms of ESG. So let's bring that together in an investment process that benefits from those kind of results. And we feel that it's possible, and the leader will take it all. And how you can identify that leader, that is now part of the next slide, because it's not that easy to identify leaders. You have to be very systematic. You have to be very consistent in what you do, and you need a very strong foundation regarding that kind of approaches. And everything we do at MTX is built on those 4 pillars. This is really our foundation. We are bottom-up oriented portfolio managers, which means we do not try to estimate what FX is doing, what GDP is doing, or what Trump is tweeting tonight. we really look at the micro level at each company, and we take each company from one pillar to the next, to the third, to the fourth, and only if they make it across all those 4 pillars, they become portfolio candidates for us. So let's start with the first pillar on the left-hand side, the blue one. I think it's not a surprise for you that profitability is the starting point for us. You have seen how important ROIC or profitability is in emerging markets. So what we do is we take the full EM universe, no matter if a company is in a benchmark or it's out of a benchmark, we take the full universe and we screen for companies that are highly profitable. So we look basically at 3 years, the last 2 reported years, 2018, 2019, and the current year on consensus numbers. And only if a company makes it to the top quartile, to the best 25% of companies regarding their return on invested capital, they have a chance to go to the next step, to the next pillar that we look at. That's quite rigorous, what we do already in the first step of our process, because it narrows or focuses the universe from roughly 1,400, 1,500 companies to only 400 companies that are highly profitable. Of course, it's easy to look at historic numbers and current year on consensus. It gets a little bit more tricky if you start to do that kind of assessment going forward. And that's why we have defined the yellow one, the second pillar. So now we look at the industry position of a certain company, and we want to identify if the company has a certain edge, if it's leading the industry. Because if a company is leading the industry, the likelihood for achieving the same profitability like they have achieved over the last 3 years is much higher also going forward. So let's look at a practical example. If we take semiconductors, for instance, one of the features we would look at is pricing power, because it's a very volatile industry. Once a new technology pops up, usually prices for the older ones fall sharply and fastly. So pricing power can be described by a good margin compared to their peers, by a stable margin over time and not fluctuating that much. So we take a company like Taiwan Semiconductor, for instance, we compare it against their peers on that measures and a couple of others. So we always try to identify roughly 5 criteria we look at, and then we rank them on a relative basis on a scale from 0 to 100. And only if a company scores 75 or higher, they are eligible. Because those kind of companies, they are leading the space. They have a higher likelihood of achieving a high profitability also going forward. Then we do the intersection of the first and the second pillar, and we end up with roughly 300 to 350 companies that are eligible for us. And for us, this is the part of the overall EM universe that has a higher likelihood to outperform going forward. Because those kind of companies, they have shown that they are highly profitable, they are leading the space, and they should be profitable also going forward. As you see, that kind of assessment is purely quantitative. We have defined certain screens or matrices that we run, and that's why we call ourselves MTX. After we have done that, we completely switched the approach. We now really make a deep dive in each of the companies. We want to understand the business model exactly. We want to get to know the management. We want to know who are the competitors. We want to know everything around that. You have heard that probably a couple of times from other fundamental managers. But we also want to be systematic. We want to keep to rules. So we doing that in a very systematic fashion, that kind of investment case that our analysts are working on. We have defined roughly 80 different questions that they need to answer. And this is a little bit like the pilots before they can take off the plane and go to the runway. They have to take out the handbook, they have to check everything, they have to make the mark in order not to forget or to oversee anything. Once we have done that, and of course, a very important part of those kind of company assessment is our own financial models. We now make our own key assumptions for sales growth, margin growth, leverage, tax rates, and that kind of stuff, which brings us to cash flows. We can discount and derive at a target price. You see there in the pink box, there's a hard limit for a new portfolio position. We can only initiate a new company or a new position for the portfolio if there is at least 25% upside between current market price and the target price that we have calculated. And we have that rule to be very disciplined in selecting companies. Because remember, the way we search for companies, highly profitable, leading their space compared to their peers, good management, good balance sheet quality, everything fine around that investment case. Unfortunately, that often comes with high valuations. And in those moments, we want to be patient. We want to be disciplined. We take the hand off the table and wait for a better entry point for those kind of companies. And then last but not least, you see ESG is an own pillar for us. So that underlines the importance of ESG in emerging markets to get a holistic picture of the company. So what we do in terms of ESG is we follow our own system, our own concept that we have developed. And that's why we also have 3 people on board to do much of that work. We go on a sector level and we define 20 to 25 criteria that are important for the future generation of cash flow of a company. So you can, of course, get a lot more data in terms of ESG, but many of them are not material. We try to focus on asking the right questions instead of asking too many questions. Once we have defined that on a sector level, we go to the companies we look at that have passed the first 3 pillars of our process, and we score them on a scale from 1 to 5 on each of those kind of criteria. For 5, you have to, this is the best score that you can achieve. 1 would be the lowest. And again, we try to be very objective in a subjective area like ESG where we are acting. So we define rules when you get a 5 and when you get a 1. So let's look at independency of board, very important in emerging markets. You get a 5 and 75% of the board members are considered to be independent. You get a 1, the worst score, if less than 25% are considered to be independent. And then you see a certain part of that 4th pillar is green and a certain part is black. Once we have done all the calculation, we derive at an ESG rating for the companies we look at, and only the upper half of them in terms of that rating is eligible for us, which means exactly that we sort out the most risky ones. And remember back what that means for performance, that should generate alpha if you avoid the most risky companies in terms of ESG. And that's why we implement ESG really from that kind of risk management perspective as an important but last foundation or pillar that we look at. As said, all the companies that we might look at, they need to pass by those 4 pillars, and only if they make it across all those pillars, they are eligible for the portfolio. And you can probably imagine that are not a big bunch of companies that make it over those 4 pillars. It's a very focused, high conviction portfolio that we construct, roughly 30 to 50 companies that we invest in that meet all our criteria. And what brings that in terms of portfolio characteristics, if you look more from a bird's eye perspective on those kind of companies, and we try to group those kind of characteristics in 3 different groups to give you an idea what kind of tilts you should expect. So it's about of quality on the left-hand side. And in black now, you always see the portfolio. In blue, you see the MSCI Emerging Market Index as a reference. We have much more quality in the portfolio as we are that rigorous in filtering and then looking at the companies. So return on equity, another measure for profitability. The black bar is much higher than the blue one, which means the portfolio companies are much more profitable than the average peer company. But then look at another thing like leverage. So the blue bar, the average EM company is quite highly geared. And especially in Asia, that debt is often short to midterm, which means there's a certain refinancing risk. The companies we own, they have a negative gearing, which means they have cash on their balance sheet. And of course, also during difficult market phases like we have seen in the first quarter, for instance, this year, those kind of companies, they are able to act. They can benefit from any consolidation that might happen, they are able to expand, and usually those kind of companies step out stronger from a crisis compared to the level they have entered. I mentioned with the third pillar that we pay a lot attention to valuation. So that's what the second grouping in the middle is about. This is a very short-term measure of valuation, just 12 months forward PE. And again, you see that we have a certain discount to the overall market. And I think that's quite striking, because if you look on the left-hand side on the high quality of companies that we have, this is something you will not often find if you look at quality managers. Usually they do not pay that much attention to valuation. They come often with very high valuations in terms of short-term PE. We are usually in line with the market or even with a discount. Quite a distinctive feature of the way we invest. And then, of course, emerging markets, it's about growth. On the right-hand side, that's 12 months forward earnings growth that you can see there. And again, striking difference, we have much more earnings growth in the portfolio than the overall market has. So very distinctive and interesting combination of certain tilts, higher quality at lower valuation with an attractive growth potential that you can achieve with such a rigorous approach that we apply. And as we are very systematic, very rule-based in the way we construct that portfolio, this is something that is very consistent in terms of portfolio characteristics over time. If you look back in history and take out several moments of time, the portfolio always looks pretty similar in terms of style characteristics. Yeah, and last but not least, performance, of course, is very important. You see here the institutional share class in US dollars after all fees. Black again, this is the fund. Blue is the MSCI Emerging Market Index. Let's start with the index. Quite a bumpy ride over the last, let's say, 8 years. And in terms of absolute performance, remember this index has no cost. You did not achieve that much, but you had the fun of that roller coaster ride, obviously. If you look for the right companies in terms of profitability, in terms of industry positioning, in terms of how they address ESG, and you buy them at decent valuation, you see you can achieve nice return in that respect, looking at the black line, which is much higher than the blue one. And if you look at the table on the right-hand side, you see on a yearly average that brings you an outperformance of more than 400 bips. Of course, you also have the fun of that roller coaster ride. We are always fully invested. We leave all asset allocation decisions to you. What you get is pure equity product, which means, of course, if the market is going down sharply, we also go down to a certain extent. But you can achieve a very nice alpha if you consider ROIC, if you consider ESG in a proper way, and look also at the other features of those foundations we have. So what makes us unique? This is the concluding slide. This is a very unique combination of systematic screening, the first two pillars for profitability, industry positioning, and followed then by fundamental research, doing a deep dive on each company, not only on the financial side, but also on the ESG side. You know what you get. We have defined criteria that are very clear and transparent. We define what a market leader is. It's a top quartile company in terms of return on invested capital, in terms of industry positioning, above average in terms of ESG. So it's very easy for you to understand and transport that also to your clients. And then we pay a very strong focus on valuation, which means that we achieve those kind of portfolio at a decent valuation level, which of course offers you quite a good opportunity to achieve also an upside then going forward. And last but not least, ESG is integrated since we started to manage that kind of strategy. And well, nowadays, of course, you cannot afford anymore to not look at ESG. And now you know how ESG really plays a crucial part in your emerging market portfolio. It's really about avoiding risk, providing a holistic view on those kind of companies. And if you consider now all the secrets that I've shared with you over the last couple minutes, like the 4 pillars, how to integrate ESG, we are convinced that you can invest very successfully in a very interesting asset class like emerging market equities. And with that, I'd like to thank you for your attention and for listening. Hope to speak to you soon in the Netherlands once we can travel again. Goodbye.